This is InvestTalk. Independent thinking, shared success.
Hi, InvestTalk. I am calling to get your opinion on the stock Gilead. The symbol is GILD. Wanted to see what your thoughts are on the stock and what would be a good entry point, or should I hold back on it? I'll be listening to the answer on your podcast. Thank you.
All right, looking at Gilead Sciences, and they make they had issues a long time ago, which was their hepatitis, I think it was C, hepatitis B, treatment was too good. It was curing people, and they had a boondoggle curing a bunch of people, but then, suddenly everyone was cured, and they had to kind of pivot and use that cash flow elsewhere. They've done that. Now, this has rallied dramatically from the low 60s all the way up to 111. It was in the low 60s just last summer. So you're talking in 8-9 months, it's had a massive rally. That's because earnings are expected to go from $4.62 last year to $7.93 this year. So that is a dramatic move and something that has propelled the stock higher. Now, it's absolutely overbought in the short term. So this is more of a trade, momentum trade at this point. The valuations are no longer cheap, but that depends on kind of the progression of their pipeline. And so that's what you're betting on here. And that's what the market is betting on. It's doing much better than a lot of the other pharma names. So I don't mind it because it has a good business, fairly good balance sheet, et cetera. So I'm going to give it a thumbs up, but probably on a pullback, I'd want to see it around $100 per share. Now it's at 111. That would be an area to pick up Gilead. Thanks for the call. Now, I hope you've been telling your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play. Be sure to head over to our YouTube channel and leave a comment over there with a question. And let's tackle one of those now. Wade Mulville says, what are your thoughts on SBIT? I understand that inverse funds pose a lot of risk and are often used more by day traders, but I'm curious to know if this could be used as a way to bet against Bitcoin over a long period, say 3 to 6 months. If I believe Bitcoin still has potential downside, would I be advised to allocate about 1 to 1.5% of my portfolio to a fund like this? If not, what are some other ways to hedge against Bitcoin's falling price? Well, this is, I believe, let me pull this up here. SBIT, SBIT. So as you would imagine, short Bitcoin. That's what it stands for. And this looks like it's just the inverse performance of Bitcoin. And it's obviously going up now because Bitcoin's breaking down. Would you want to hold it for, I would use it more as, you're right, it's for trading. And, can you hold it for 3 to 6 months? Sure. It's not levered. It doesn't look like. And so that's fine. It's just a matter of how much downside does Bitcoin have. If you pull back, let me pull up a chart here of Bitcoin and go all the way back to, now if you're on YouTube, you'll see my chart here. I'm going to go back all-time high. Okay, so in 2021, it peaked out right around 68,000. And that was in the fall of 2021. It bottomed in the fall of 2022. So it went down for about a year, and it went all the way down to the low teens, right? So you're talking about an 80% drop. So could you see something similar with Bitcoin again? I see no reason why that's not possible. Could Bitcoin get down to 30,000 again? I think there's no reason that's out of the realm of possibility. It's certainly possible. I'm not calling for it, but it's certainly possible. So to me, it's more of, I wouldn't buy this and just hold it, just to say, okay, and hold it for 3 to 6 months. It'd be more of, I'd be watching the technicals. Are there any signals that the new downtrend is starting to reverse once again? Then you probably want to get out of it. And then and that goes back to, this is a trading mechanism. Bitcoin is very volatile and in both directions. And so you need to be able to be nimble and get out, because as soon as that downtrend breaks, this will probably rally 20, 30%, and you don't want to be caught on the wrong side of that. So make sure you're using it as a trading vehicle. You're watching it regularly. You're not sitting and putting it in a drawer for 3 to 6 months and then looking at it again down the road. This is an active market in crypto that you have to be engaged with on a daily basis. It trades 24 hours a day, right? So I don't mind using this for that purpose, but understand what it is. It's a trade. It's speculation. It's not an investment, and you need to treat it as such. Okay.
Thank you for watching.
If this video was helpful, please give it a thumbs up and subscribe to catch our upcoming videos.
Hey, thanks, Justin, for taking my call. I've become enamored with a certain strategy, and I wanted your views on it.
Okay.
I just finished reading Phil Town's Rule 1 investing book, and he says that all these metrics I'm about to mention, ROIC, revenues, EPS, cash flow, and book value, have had to grow at least 10% a year for 10 years. And that kind of fits my risk tolerance, and I'm just wondering what you think about that.
So you're talking about targeting companies that are growing those by 10% per year?
Yes.
Okay. Yeah, I mean, those are all good metrics. I like that it's being relatively conservative. There are certain ones that I like more, like return on invested capital, right? I want that to be consistently in the double digits or higher. So that's there's certain rankings in those metrics that I would prefer. But generally, those are all good numbers to continue to look at, continue to want to see improvements on. Now, it's easier said than done. It's you check all of those boxes over extended period of time is not easy. And you also have to consider the time frame you're looking at, because is it going through some type of a recession? You might throw out great companies because they were in the travel industry, for example, and COVID hit, or they were in the banking industry and then the financial crisis hit, but they were thrown out with the bathwater. So it's a good starting place, just like anything. And it's what you're talking about is quantitative analysis, just looking at the numbers. And that is one part of it. That is definitely a big part of it. But there's qualitative analysis as well, leadership. Because what if the leaders during that time are now gone? What if it's a whole new ballgame, new CEO, new leadership team, and they are going in a completely different direction? So you have to understand that. What about industry dynamics? What if they're changing dramatically? So you have to understand that. What about regulatory? With Trump in, obviously, regulations are likely to change. Some will benefit certain companies and others not so. And so you really have to look at this as a basis. It's a great basis for what you're looking for, but it's not the holy grail. It's not the end all be all. But I hope you have good luck with it. And if you have any questions in the future, we're always here to help.
Thanks, Justin.
No problem. Thanks for the call, John. Now let's keep things moving and catch a fresh question from the comments section over on our YouTube channel. Iraq Don says, curious what you think of one that in the past you liked a lot. Homebuilder NVR has come down quite a bit off its highs. It seems elevated to me. Are you still a fan? And if so, where are you buying? This is one of those ones. I love this one because it's trading at a very high price per share, $7,335 per share. Now that's down from a high of nearly 10,000 just in October. Okay. So nice solid pullback here, down about 30% from its high. Let's call it 25. And the whole sector is down. Tariff worries, higher interest rates, an economy that is weakening to a degree. All of this is certainly weighing on the sector as a whole. And just because NVR is one of the better operators out there doesn't change anything. Okay. It doesn't mean that it's not affected by the same things other home builders are. Okay. Now, if you look at NVR's profitability and their balance sheet, return on equity is 39%. Return on invested capital, 32%. And they have net cash on their balance sheet, free cash flow of $1.3 billion on $18 billion enterprise value. It's about a 6 or 7% free cash flow yield. That's pretty good. And they are buying back, let's see, as of December 11th, they were purchasing $750 million worth of common stock, and it's a $22 billion market cap. So, they're going out there using that cash flow to repurchase shares, and that's a good use of capital because their return on capital is very high. So I like this. Are home builders getting to that buy point yet? I think we're getting pretty close. This is now back down to the 100-day moving average. I don't actually mind this as an entry point. Now, could it go all the way down to roughly 6,000 from 7,300 right now? Yeah, I think there's a potential for that, especially if you go through a deeper economic slide and interest rates don't drop materially. I think you could see more downside. But, overall, if you look at profits this year, it's supposed to be over $500 per share, about mid-teens multiple for a very good company with good profitability and good balance sheet. I think this is getting to a point where it is attractive. That is NVR. Now, let's touch a bit on the current economic environment and why the market is reacting this way. Now, on Friday, the S&P was down 1.7%, and the last 2 days, it's been down about another 1.5% each day. So you're talking about a 5% slide in 3 days. And this is much bigger of a slide than we've seen in the recent past. Even bigger than the DeepSeek drop. Remember when DeepSeek had that news? And this is not just about the DeepSeek news and the Microsoft news, but it's also on the economic front. On Friday, we had Purchasing Managers Index that showed services contracting for the first time in more than 2 years. Services. Remember, services are 2/3, 3/4 of our economy. Roughly 70% of our economy. Now, manufacturing picked up a little bit, but new orders did not. They were actually down. So that was more of a flash in the pan. There's no signal that manufacturing will continue to rebound. And then you had housing starts and new home sales, all down by a lot with rates staying higher, as well as more people worried about their jobs, about tariffs, and what this new administration brings. And then that's not just flash in the pan numbers, but it's what the Michigan Consumer Sentiment Surveys said. And that was negative across the board. And not just by poorer individuals. It was across income brackets, across wealth levels, all ages. Sentiment was down widespread. And most of it has to do with the tariffs. Then you had inflation expectations. This is why you got the drop in mortgage rates, treasury rates, was inflation expectation break-evens, those fell. So market expectations for inflation dipped down. And once again, if you look at inflation expectations from manufacturers, they're actually seeing higher costs already for raw materials. And they overwhelmingly blamed tariffs. And this consumer sentiment drop was the largest drop, had the largest drop on durable goods, 19%. Plunged. Basically, people saying, hey, I'm not going to go out and buy a big ticket item, car, a new washer and dryer, whatever, because tariffs are going to be too big. It's going to cost too much. Now, on the unemployment side, everything seems to be hanging in there. But if Doge's effects are what they say they are, which we know that, he's kind of inflated what he's really been able to save. But if he goes full bore with laying off federal workers, it could increase unemployment from where it is today by about 15%. Okay, so we're in the low fours. It'd easily get unemployment up into the 5% range pretty quickly. And in the labor market, it kind of feeds on itself. And that could trigger a recession. Remember, said this before many times. First thing you learn in macroeconomics is C plus I plus G plus X. It's how you calculate GDP. Consumer, investment, government, and then net exports. So government, if that pulls back dramatically, that can easily create a recession. And so that's what the market is starting to price in. And we're in an environment, it's fiscal dominance, meaning while everyone talks about the Fed, and it's certainly important to a degree, what's far more important in today's market has to do with what governments are doing. How much are they spending? How much are they cutting? Are they issuing long-dated securities or short-dated securities? Because it's such a big part of our financial system now, this debt. And so I just wanted to give that update because it's very important to get that perspective of what's causing market volatility to rise right now. It's not just the AI stuff. It goes beyond that, and it can feed on itself. So that's what I've said. I've suddenly become modestly bearish. Modestly. Not calling for a crash. Everyone would think it's not an on and off switch, okay? So many people are like that. Oh, buy or sell. There's trimming. There's, shuffling your positioning. Look at what's trending higher in markets today versus not, right? So getting in line with those trends is very important. And so don't hesitate to make moves and be cognizant that these risks are building in markets. Now let's play another InvestTalk caller question now at 888-99 chart.
Luke. This is Paulo from Gaithersburg, Maryland. I'm originally from Germany, and I've been looking into some defense spending, and it's going to grow with the new administration and current geopolitics. So do you have any suggestions where to look at if you think that this is a space that's going to grow within the next 2 to 10 years, let's say? I love the show, and bye-bye.
Well, I assume what you're talking about is the fact that Europe is going to have to start spending more on defense. It's pretty clear that based on our fiscal situation, based on who's in the White House, there could be a decline in at least traditional defense spending to support NATO and our allies. So I think that's one of the reasons why Lockheed Martin stock is down from 620 all the way to about 450 right now, 440. And I think that will continue. Now, there are rules on the show, SEC. I can't give you recommendations. Can't. Now, if you call in, if you notice, we don't talk about a company unless somebody asks me about a company. That's the rule. Okay. So I can't sit here and say, hey, go buy this company. Or look at this company. What I can say is, yeah, I do think that there's going to be higher demand from Europe. And it's just a matter of who those companies are that are going to benefit. They're going to be American-based defense companies. Maybe, potentially, some. But obviously a lot less than if we are the ones, if the United States are the ones that are purchasing that military equipment, right? So I would just look there. I like where you're thinking. I do agree with you, but I can't give you a specific recommendation. Now, real quick, let's fit in another listener question. MQ Cali says, looking to invest $1 million in a way that will generate income. My folks just inherited some property from their recently deceased parents. They aren't too keen on being landlords or working with property managers, so they're inclined to sell those properties and invest the money. What do you guys advise for someone looking to invest $1 million in a way that will generate income for them and provide less of a hassle than managing property? My folks are both in their 60s. It's a great question. I get this all the time. People have properties, they don't want to be landlords anymore, that they inherited it, or they're just tired of it. And they, especially with today's elevated prices in real estate, in many instances, it makes a lot more sense to go sell that property, get the cash, sell it at a cap rate of 4%, especially here in California, the coast's kind of elevated price where prices are elevated. You can go and reinvest that in, say, the bond market, right? Corporate bonds yielding 6.5%, 7% right now. You get a much better yield and no headache, right? No landlords to worry about. And so, that's generally what we would say. Now, not good hedge against inflation. Bonds aren't. So, you probably want to mix. This is a question that I usually answer on a portfolio review. So I would encourage you to go schedule one on InvestTalk.com. We can talk about this more directly, kind of risk tolerance levels. What kind of income do they need? Is it small amount of income? Is it a large amount of income? What other assets do they have? What other risks are they taking, et cetera? All these are things that we walk through on a portfolio review. So I would head over there.
Get ahead in your financial journey. Sign up for the KPP Premium Newsletter and receive tailored insights every week.
Hey, so I'm looking to get some exposure to foreign markets. I currently only own U.S. stocks, so I'm looking at an ETF that would give me some exposure to foreign markets. I'm looking right now at the BNY Mellon International ETF, ticker symbol BKIE. Seems to have a pretty low net expense ratio. Its portfolio's relatively diversified, a little heavy in financials, but I'm fine with that because I don't have a lot of exposure to financials. The chart looks pretty good. It seems to be doing pretty well year to date. It's actually doing better than the S&P. Just want to see if this is a good stock to start getting exposure in foreign markets with. Thank you.
All right, looking at the ETF, not a stock, ETF, BKIE. This is the BNY Mellon International Equity ETF. I love this. I love that calling about international exposure. Definitely starting to outperform our broader markets. And sentiment on foreign markets got really bad last year, and I definitely think it's time to up your exposure to those markets. The value is just there, and as you said, this ETF has much better balance in the sector allocation. Technology is only 10% of this fund, as opposed to S&P, it's over 30. Okay, and you have very little energy or basic material exposure in the S&P versus this is 6 in basic materials and 5 in energy. Still not probably high enough, but much better. And industrials at 17%, just broad-based exposure to various sectors. And I really like that. And if you look at profitability, it's pretty good. The average name within the space, but the free cash flow yield ex financials is 21%. That's really high. That's really good. Okay, so there's a lot of good companies overseas that are underinvested in, underappreciated, and this is a great way to gain exposure. So I have no problem with it. That's BKIE. Now the price is also cheap. I want to mention that. Only 4 basis points net expense ratio. So that's pretty good. Morningstar gives it 5 stars. And yeah, if you're looking for a broad-based ETF to get foreign exposure, we're not doing much work, not high fees, this would be a good one for that. Now, lastly, let's touch a bit on really what's working in this market. And it's 4 sectors: telecom, staples, pharma, and what's the other one? REITs. REITs are starting to do better. Why? Because these are bond proxies and they're focused on cash flow. What's not working? Tesla, NVIDIA. Meta is the only one that's really up since the beginning of the year. The rest are either flat or down. And if you look at sentiment still remains relatively bullish if you're going by Citi's Panic and Euphoria Index. So that's why I don't think the market has is likely to, bottom out in the next 1 or 2% this year. It's going to be a choppy market. We're also going to get big rallies. You're going to see that this year. You're going to see big rallies, 10, 15% rallies in short periods of time. That's what happens when there's change in markets. You get big sell-offs and big rallies. And more often than not, the rallies are even more powerful than the sell-offs. The sell-offs kind of roll from one day to the next, kind of like they have over the last 3 days. This is what it feels like in a bear market. If you haven't been in one in 2 years, right? I haven't been bearish in pretty much 2 years. And when you look under the hood of the market, you have to call a spade a spade. You have to call balls and strikes. That's what we're here to do. You never want to be perma bull. You never want to be perma bear. And sometimes you can be darn right neutral. That's okay too. Understand that this is just like in life, there's shades of gray. And this gray is slightly red right now. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play. And be sure to rate and review on iTunes as well. And it's official. We have now surpassed the 59 million download mark, all thanks to you. Independent thinking, assured success. It's InvestTalk. Good night.